Welcome to Inch High Private Eye, where we break down the complex stories impacting your finances and the digital world. I'm your host, the founding crypto diva, Felicia. Today, we're diving into a story that sits right at the dangerous intersection of hype and harm. The world of cryptocurrency promises fortunes, innovation, and a new frontier of finance, but for every legitimate project, there's a shadow lurking, ready to exploit the hopeful and the uninformed. This is the story of one such alleged shadow, a man named Ed Zimbardi, and a so-called crypto program that, according to federal regulators, was anything but programmed for success. In a complaint filed just this week in the U.S. District Court for the Northern District of Georgia, the Commodity Futures Trading Commission, or CFTC, laid out a stark accusation against Ed Zimbardi. The CFTC is one of the key federal agencies that polices financial markets, and lately they've turned a serious eye toward the Wild West of digital assets. According to their lawsuit from roughly early 2024 until the scheme came crashing down this year, Zimbardi operated what he called the crypto program, and the promises he made were the kind that light up dollar signs in your eyes. He allegedly solicited millions of dollars from investors, promising them astronomical and, more importantly, guaranteed returns. Think about that for a second. In the volatile world of crypto, where prices can swing 20% in a single day, the word guaranteed should be a massive red flag. Zimbardi allegedly told potential clients that his program used a proprietary, high-speed trading bot powered by artificial intelligence to execute thousands of profitable trades per day. He claimed it was risk-free, zero chance of loss. He was offering a golden ticket in a market known for its risks. He attracted investors from all walks of life, retirees looking to bolster their savings, young professionals hoping to get in on the crypto boom. He presented them with sophisticated-looking but ultimately fake performance statements showing their accounts steadily growing. Week after week, month after month, the numbers went up. It looked like he had cracked the code, but the CFTC alleges that the code was a complete fiction. According to the complaint, there was no sophisticated trading bot, there was no high-speed AI-powered strategy. In fact, regulators allege that very little, if any, actual trading took place at all. So where did the millions of dollars from investors go? Why was he allowed to steal for so long? If dude looked like me, GBI would have swooped down and shut him down with a quickness. If the allegations are true, it's a story as old as scams themselves. Zimbardi is accused of misappropriating investor funds for personal use. We're talking luxury cars, lavish vacations, high-end real estate, and other personal extravagances. The classic hallmarks of a fraudster living large on other people's money. The lawsuit describes a textbook Ponzi scheme. The so-called profits that some early investors received weren't from trading at all. They were just funds from new investors being passed up the chain to create the illusion of a profitable enterprise. This keeps the scam going, encouraging existing investors to put more money in and luring new victims with tales of success. But like any Ponzi scheme, it's a house of cards. Once the new money dries up, the entire structure collapses. And that's when the regulators stepped in. The CFTC has charged Zimbardi with violating both federal law, specifically the Commodity Exchange Act, and Georgia state laws. The charges are serious: fraudulent solicitation and misappropriation of funds. They've accused him of lying to investors to get their money and then stealing that money for his own benefit. So what happens now? The CFTC is seeking several things from the court. First, they want restitution for the victims. They are fighting to get the defrauded investors their money back. Second, they want disgorgement of all ill-gotten gains. That means Zimbardi would have to pay back every dollar he allegedly made from the scheme. Third, they're seeking hefty civil monetary penalties as punishment for the violations. And finally, they are asking for a permanent injunction which would ban Ed Zimbardi from trading in commodity markets and from registering with the CFTC ever again. Essentially, they want him kicked out of the industry for good. This case, while still in its early stages, serves as a powerful and timely cautionary tale for anyone looking to invest in the crypto space. The allure is real, but so are the dangers. So how do you protect yourself? Regulators point to the red flags that were all over this case. First, the promise of guaranteed high returns. Investing, by its very nature, carries risk. Anyone who promises you guaranteed high percentage profits with no risk is almost certainly lying. Second, a lack of transparency. Zimbardi's program was allegedly built on a secret or proprietary trading bot. Legitimate investment opportunities can explain their strategy. If someone's answer is it's a secret formula, you should run. And third, look for registration. In the US, individuals and companies offering investment services are typically registered with agencies like the CFTC or the SEC. You can often look them up online. A lack of registration is a major warning sign. The age-old advice has never been more relevant. If it sounds too good to be true, it absolutely, positively is. The case against Ed Zimbardi will now move through the Georgia court system. We'll be watching to see how it unfolds and hoping that the victims in this case can find some measure of justice. That's all the time we have for this edition of Market Watch Minute. Thanks for listening. Stay informed and stay safe.